what we're going to do here is a little supplement to the cash flow report. Why? Because it would be a good idea just to see one more way of approaching at least the section called cash from operations in the cash flow report. I'm going to be showing you my shortcut think it through stupid type method in order to understand how to remember what to do. So cash from operating, and so we're going to start with the net income on an accrual basis, and we'll set up some phantom numbers for this example. Let's set up $1 million and let's see what happens. So what you do is if you remember from class, you take the balance sheet figures for year 1, year 2, and then you look at the specific accounts that have adjustments that would have affected the income statement on an accrual basis. So certainly accounts receivable affect the income statement on an accrual basis, accounts payable do, accumulated depreciation does, we know about that, prepaid balance sheet accounts affect accrual income, and so does deferred revenue. How do you know? Well, what would be the offsetting entries? If the offsetting entries is to the income expense side of the financial statements, that's how you know that these accounts are affecting the income statement on an accrual basis. Let's say that one more time because that's pretty important. How do you know what accounts to include in your cash flow from operations? It's the accounts that on an accrual basis are affecting the income statement. The other side of their entry, it goes to the income statement. So you have to just think through what's the other side of accounts receivable? It's revenue. What's the other side of accounts payable? It's the expenses. What's the other side of accumulated depreciation here? It's depreciation. Prepaid is expense. Deferred revenue is revenue. And so all these accounts and more affect the net income on an accrual basis. So having said that, let's see what my shortcut method is. Let's take an example, $95K for receivables at the beginning, $75 in the next year. And what I do is I set up phantom T accounts for these numbers. Here's the numbers again. And let's see how the phantom T account method works here. So this was, sorry, wrong side. It was there, and it went to 75. How did it get there? Well, there must have been this, a credit. Must have been a credit. Then I pretend, it doesn't have to be, but it might have been, but I just pretend it doesn't have to be. This is just to get my cash. I pretend that the other side of the entry was cash, and if that's so, then to balance, it must have been a debit to cash that affected that number. Debit to cash, is that using or providing cash? Using or providing? Well, it's certainly providing cash. It's like putting money in the bank. So then when we go back to the cash flow report, let's start one fresh where we have some room. If we do the cash flow report, we're going to start with, this is how they all start, the net income on an accrual basis, and then we add or subtract as the case may be. So here, what did we say? The change in accounts receivable, the delta in accounts receivable, provided cash, $20,000, because it's a debit here. So that's providing cash. So then what we would say is, okay, cash from AR, cash from AR. So we would say increase of, or actually it was a decrease of AR. It's called a decrease even though it's going to increase cash. So that gets a little confusing. So don't worry about that language too much, but realize just by looking at it, it was a decrease in accounts receivable. So you would say decrease in accounts receivable, but they provided cash. Why? Look at my phantom entry. Cash balanced the entry right there, and so that means there is more cash. So now we add back the $20,000. Let's do another one, and maybe you'll start catching on. Let's set up accounts payable. Let's use the same numbers because it may make it fun, and you'll get to see how it works. So again, set up the T accounts payable. Started at 95, it ends at 75. How do you get there on a T account? You must be making a debit to accounts payable. That's how you reduce accounts payable. If you pretend that the other side of the entry is cash, again, just for cash flow reporting, to do a debit here, it must be that you credited cash here to balance. Is that using or providing cash? Well, this is using cash. So now back here, we would say that there was a decrease in accounts payable. But to get that decrease, as we see here, we used cash, $20,000. So this time, you're going to show it as a negative because it's decreasing cash to move from the accrual net income up here to a cash flow report. Now, of course, accumulate depreciation is a pretty simple one, so depreciation is always an add back, whatever the depreciation was, and that's whatever it is. And then the same thing you do with these other accounts here with prepaid, deferred revenue. You do the same thing. Set up the T account. Let's do one more just for the heck of it. Why not? I'm not getting paid for this anyway. So we have prepaid. Do the same numbers again. Once again, same numbers. 95K, 75K. All right. So now let's set up the phantom T accounts. Prepaid. Was 95, and of course if it was prepaid it was a debit, and then it went to 75. How did I get there? I must have had a credit for 20K. If my other account, again in this phantom approach, is cash, then to do that it must have been you guessed it, a debit to cash. Does that mean using or providing cash? Well, by now you understand it's providing cash. So go back to the sheet itself. Here we would say a decrease in prepaid. How do you know? Well, if you're not sure, just look at the balance sheets. Here it is, and what is it? It's a decrease. So you go back here, the right decrease in payables. Look back to your phantom entry. How did it get there? It provided cash, so you're going to add cash. And that's how this cash flow gets done the right way for people like me who can't remember. I certainly am not going to remember formulas, but I can remember this phantom approach of just assuming that the increase, decrease, whichever way it takes debit or credit to make it happen, whatever it takes debit or credit to make these changes happen, the offset is a phantom account of cash for the cash flow report. And that is that.